Welcome, everyone. So today we're going to dig into a concept that's absolutely fundamental in corporate finance and accounting: dividends. Now, for those of you who are aiming for a career in management, or even if you just want to be a smart investor, you have to understand the mechanics behind dividends. It's so much more than just getting a check in the mail. It's really about understanding the language of a company, how it signals its health, its confidence, and its commitment to its owners. So let's get started. Okay, let's kick things off with a really basic but incredibly important question. You see on the screen, a company turns a profit. That's great news, right? But that money, which in theory belongs to the shareholders, the owners, is sitting inside the company. So how does it actually get from the company's bank account into your bank account as a shareholder? Well, it's not some automatic process. It's a very deliberate, strategic decision that tells you a whole lot about what's going on inside that business. And that brings us right into our first section, the actual mechanism for sharing these corporate profits. We're going to look at the specific rules and the formal procedures that dictate how a company can distribute its hard-earned money back to its owners. So let's get a really precise definition on the table. A dividend is a distribution of a company's earnings. Now let's unpack that sentence because every word there matters. First, the source: earnings. Specifically, dividends are paid out of an account on the balance sheet called retained earnings. And that's not just last quarter's profit, it's the total cumulative profit the company has earned and kept over its entire lifetime. Second, it's a distribution. That means real value is flowing out of the company. And third, and this is so important for understanding how corporations are run, the decision is made exclusively by the board of directors. Not the CEO, not the CFO. The board makes the call. It's a strategic decision, not an operational one. It's easy to just think of a dividend as a little thank you note to investors. But honestly, it's a much more powerful signal than that. Think of it like a lighthouse in a storm. A consistent dividend signals to the entire market that a company isn't just profitable right now, but that its leadership is extremely confident that it will continue to generate strong, predictable cash flows well into the future. It's a tangible reward that says your faith in us was justified. Now, here's where it gets interesting. This thank you doesn't always come in the form of cold, hard cash. Companies actually have a few different tools in their toolbox for rewarding shareholders. And as future managers and investors, you really need to understand what these different types are and, more importantly, why a board might choose one over the others. We can basically group dividends into three main categories: cash, property, and stock. As you can see, each one is very different, and each one has a totally unique effect on the company's financial statements and what the shareholder actually receives. So let's break these down one by one. First up, the one everyone knows, the cash dividend. It's the most common, the most straightforward. The company literally sends cash to its shareholders. Now, from the board's perspective, this is a real test of the company's financial health. It's one thing to show a big net income number on your income statement. That's just accounting. It's a completely different thing to have enough actual cash sitting in the bank to send out to shareholders without jeopardizing your ability to pay your bills, meet payroll, and invest in the business. Next, we have something you see far less often, but it's a fascinating strategic move: the property dividend. This is when a company distributes something other than cash. For instance, imagine a large company owns a ton of stock in a smaller, separate company as an investment. Instead of selling that stock for cash and then distributing the cash, they might just give the shares of the smaller company directly to their own shareholders. From an accounting standpoint, it's a bit tricky. They have to revalue that asset to its current market price first. But the strategic reason is clear. You get to reward your shareholders without draining your operating cash, which you might need for a big project. And finally, the stock dividend. Now, this is where I see a lot of students get tripped up, so let's be really clear here. With a stock dividend, the company gives shareholders more shares. So think of the company as a pie. Before, you owned one slice. After a stock dividend, you own more slices, but each slice is now smaller. Critically, no value has left the company. Your percentage of ownership, your piece of the total pie, is exactly the same as it was before. So if the pie is the same size but there are more slices, what has to happen to the price of each slice? It has to go down, right? So why do it? Well, it's a way to reward investors and show confidence without spending a single dollar of cash, keeping that capital in-house for growth. Okay, now we're going to shift gears to what I think is the single most important accounting concept we're talking about today. And that's the moment a dividend transforms from just an idea into a legally binding obligation. This is where the accounting gets really serious. So let's be crystal clear about who holds the power here. The authority to declare a dividend rests exclusively with the board of directors. It's not a decision the CEO can make on a whim. The board has a fiduciary duty, a legal responsibility to protect the shareholders' interests. And that means they have to be certain the company actually has the financial strength to make good on that dividend payment. The process itself follows a very rigid four-step timeline. First, the board meets and formally votes to approve the dividend. Then comes step 2, the public announcement. We call this the declaration date. And this, right here, is the point of no return. The second that dividend is declared, step 3 happens instantly on the accounting books. A legal liability is created. And finally, sometime later, you have step 4, the payment date, when the company actually sends out the checks. I want to pause on this for a second, because this is where so many people get it wrong. They hear declaration and think it's just a press release about a future plan. That is absolutely incorrect. From a legal and an accounting perspective, the second that announcement is made, the financial DNA of the company has fundamentally changed. This IOU analogy is perfect. Let's actually walk through the journal entry that an accountant would make on the declaration date. The first thing they do is debit retained earnings. Remember, retained earnings is an equity account, and a debit reduces equity, so we're taking that portion of the profit out of the owner's pocket, so to speak. Then they make a corresponding credit to a brand new account called dividends payable. And what kind of account is a payable? It's a liability, a debt. So in one single entry, you've decreased the company's equity and increased its legal debts. This slide lays it out perfectly. Before the announcement, that money is just part of the company's retained earnings. It's a potential payout. The moment after, it becomes a legal liability, a debt recorded on the balance sheet. Now think about the real-world impact of that. As soon as you create that dividends payable liability, what happens to your current ratio, your current assets divided by your current liabilities? Well, the bottom number, the denominator, just got bigger. That means your current ratio gets weaker instantly. And you can bet that lenders and creditors are watching that metric very, very closely. If you only write down one sentence from this entire lecture, please let it be this one. A declared dividend is a debt. It's a legal obligation that is just as real as the money the company owes its suppliers or its bondholders. If the company tried to back out, shareholders could literally sue to get their money. Once it's declared, it's a done deal. It is irrevocable. So let's bring this all back to strategy and wrap up. We've just established that declaring a dividend is like making a binding legal promise. So think about this question. What is a board of directors signaling to the entire world when they voluntarily take on a new, legally binding debt to their own shareholders? They're signaling incredible confidence. It's a public proclamation that says, we are so certain about our ability to generate cash in the future that we are comfortable making this unbreakable promise to you today. And that right there is why a steady and growing dividend is one of the most powerful and credible signs of financial strength a company can possibly send. It's not just an accounting entry, it is a fundamental tool of corporate strategy.